Hello, everyone. Thank you for joining us for our Payden Emerging Markets Debt discussion today. I'm Kimberly Tipton, and I'll be your Payden Events host. We'll jump right into our presentation, and I'd like to introduce our speakers, Kristen Seva and Darren Capoletto. Many of you have maybe already met Kristen and Darren in previous meetings or by listening into our past calls. But if you haven't, you're in for a real treat. They are a body of knowledge on the emerging market asset class. Kristen Seva is a managing principal at Payden Rygel. She's also a member of the firm's investment policy committee and is a senior portfolio manager directing the firm's global sovereign debt strategies. She's also been with our emerging market debt products since inception, so she knows them quite well. Darren Capoletto is a vice president and an emerging market strategist. He is focused on emerging market strategy, and his areas of specialization include the local markets in Latin America and Eastern Europe. He's also the co-portfolio manager of our new Emerging Markets Local Currency Fund. The emerging markets bond universe continues to evolve. At Payden Rygel, we see opportunities in sovereign debt, corporate debt, and local currency debt. Today we'll be discussing the emerging market debt landscape, what's changed, where are the opportunities now, which countries we like, and where we see value. Kristen is going to start off with a discussion of why we are still positive on the asset class.
We're also going to give you a sense of how we look at these countries and the process that we follow in looking at sovereign risk analysis and looking at the different sectors within emerging markets. And then finally, how we're positioned in some of the themes in our portfolios today. So just starting out in terms of giving you some highlights for 2013, we're still positive on EM fundamentals. Growth is going to be picking up modestly across most of the regions that we follow in 2013, and inflation is contained. The largest downside growth risks that we see are going to be in Central and Eastern Europe. And in terms of looking at the recent Bank of Japan moves, which has been widely watched in the marketplace, we think that that is really reinforcing how significant global liquidity is across the world right now, and it also highlights some of the growth problems that we're seeing in developed markets as compared to emerging markets, and that growth differential continues. Attractive valuations in emerging markets now. The first quarter, we saw some dollar pay spreads widen year to date, as well as corporate spreads a bit wider. And so we think that it's a really good time to be entering the asset class from a valuation perspective. Corporate issuance continues to be very strong, and this is an area that we have been actively involved in terms of the new issuance market. It's been $137 billion year to date, and we're expecting issuance to be about $336 billion by the year end. And it's offering us a lot more opportunities to look at different corporates across emerging markets. It'll be another healthy inflow year this year at about $70 billion projected for 2013. We think that there's going to be increasing interest in local currency. Last year's inflows were concentrated primarily on U.S. dollar pay emerging market debt, but we're definitely seeing an interest in local currency this year. And we think that Japanese retail inflows in the wake of QE are expected to increase into emerging markets. We are, in terms of sector selection in emerging markets, overweight local pay and corporates within our emerging market portfolios, and particularly in IG countries where a number of the dollar pay sovereign spreads have compressed pretty dramatically with the rally last year. We've rotated into opportunities that we see in local and corporates in those countries. We also see a lot of opportunity in some of the first-time sovereign issuers, which is typically done in the dollar pay space out of Africa, out of Latin America, as well as local markets that are just opening up to new investment. I think that's one of the best times to get into some of these local markets is when they're just starting to open up, and we're going to be talking a little bit more about that. So taking a look at the big picture, emerging markets in terms of both GDP and population have grown very significantly comparing 1993 to 2013. Many more countries to choose from on emerging market indices, going from 14 countries to over 55 right now, with a couple of additions more recently to the index. And it's really, in terms of GDP, become a much more substantial part of the world GDP, and I think that's part of the impetus for a lot of the flows that we've been seeing, as investors really are looking at emerging markets as a much longer-term structural play that deserves a bigger part of their portfolio as emerging markets grow as a percentage of world GDP and as a percentage of population. Looking at global growth and across regions and emerging markets and comparing 2012 to 2013, we're still seeing very weak developed market growth. Emerging markets is going to be growing much faster, picking up moderately this year from 5.1 to 5.3%, and then also growing across most regions within emerging markets. And, as I mentioned before, I think that the downside risks are going to be probably within Central and Eastern Europe and perhaps some countries in the Middle East. Commodity market deterioration could be a risk to EM growth. That is not our base case, however, and we've seen both gold and oil come back off the lows in recent days. And the fastest growing countries in emerging markets this year should include China, Georgia, Indonesia, Panama, Peru, and the Philippines. On the inflation front, inflation is going to remain subdued both in the developed market and emerging markets. And, across regions, certainly there's been, with the growth that we expect in Asia, that does bring some inflationary pressures, but we think it's going to be moderate and unlikely to really get much central bank action out of the increase in inflation in Asia, because we do think it's going to be contained. And in terms of upside risks to inflation, that's probably going to be most likely in Latin America. And we do own linker paper across a number of different countries in Latin America, and we have that ability to buy inflation-linked products in countries where we think there could be inflation risks. In terms of central bank policy that we are expecting in 2013, really we see most EM central banks either on hold or in easing mode. Because of the growth problems that we still see in Central and Eastern Europe, we're expecting some continued cuts from some of these countries, including Hungary and Poland, also Russia. But most other central banks, with the exception of Brazil, we expect to be on hold. And then in terms of what we expect in terms of yield to maturity, we have a number of different countries here, what they're yielding now on the GBI-EM index, which is the local pay index, and then what our 6-month yield forecast is going to be in many of these rate markets. So as you can see, we think there's scope for local rates to continue to come down across emerging markets, and we'll be talking more about that. The Bank of Japan, in terms of QE, we think is going to be affecting emerging Asia. Depending upon the country, it's going to be different reactions. Export-driven economies that are going to be most impacted by the Japanese yen weakening are really going to include South Korea and Taiwan in particular. We think that the more open economies in Thailand, Malaysia, Indonesia are not going to be as affected. They are not competitors of Japan in terms of export markets. We also think there's some more idiosyncratic stories in local markets, particularly in countries like India, Indonesia, and Sri Lanka, that will make those markets react in different ways and not just tied to what's going on in terms of Japanese QE. Technicals in emerging markets are still quite positive. As I mentioned, we're expecting this to be a strong year of inflows into emerging market debt. And, you can see the composition last year, as I mentioned, mostly interest in hard currency. I think that came from people being a bit concerned about currency volatility in emerging markets in the wake of some of the euro volatility that we've seen over the past couple of years. Since I think that many of the tail risks have been removed in Europe, I think there's growing confidence amongst investors to step back into some of the local currency emerging market debt, and that's why you're seeing more interest this year, as well as valuations, I think, are attractive as well. So we're expecting some more inflows this year in terms of the composition to be larger in local. The next chart in terms of looking at emerging markets as an asset class and looking at the growth here in orange, that shows you the growth of local pay markets, and then in blue, the growth of corporate markets. This just gives you a sense of how the emerging market asset class has changed very dramatically over time. And you can see that in the number of countries that are on dollar pay indices, the fact that many, many more countries in the universe are investment grade, as you've seen continual upgrades in credit quality to emerging markets. And we think that as we talk about how we look at emerging markets, we are really trying to get a sense for what we think are total return opportunities in each country between the dollar pay, local, and corporate, and thinking through what makes the most sense in terms of asset allocation. And we'll be talking more about that when we look at our process in the next section. As I mentioned in the introduction, corporate issuance has been very strong last year, and we're expecting that to be strong again this year. Last year, most of the issuance, about 75% of the issuance, was investment grade. And this year, we're expecting probably 50-50 in terms of the investment grade high yield split between new issuance. We're seeing some more high yield companies issue this year. But definitely the universe is growing and providing a lot more geographic diversification in terms of where we can choose to invest in corporates, as well as sectoral diversification. The size of emerging market corporates has also become very significant when you put that in comparison with other asset classes and fixed income. And so now the EM corporate asset class is about the size of the U.S. high yield asset class at $1 trillion. So I'm going to turn it over now to Darren to give you a sense of how we're looking at these countries and how we're thinking about investing across the various sectors.
Hello, everyone. So Kristen gave you the broad overview in terms of the asset class, our macro views, and the opportunity set as it's increased with tremendous amount of corporate new issuance, the local aspect, and the dollar pay. I'm going to speak specifically to how we look at the asset class in terms of our process and our approach to investing. On page 14, I'm going to start simply with an overview of the team. Given the growth in the asset class, the growth in demand for our product, we have expanded our team, and this page will give you a structure of that, which will help fold nicely into our process for investing in the various markets. Just briefly, at the top of the page, we have our Investment Policy Committee, which is responsible for the strategy oversight and broad overview of risk management. In the blue middle section is the dedicated emerging markets team, led by Kristen. And the idea within our emerging markets team is to have country analysts, and as an example, Kristen has a focus on Latin America. Alex King, also listed here, is a junior country analyst in Latin America. So we'll have dollar pay sovereign country analysts who look at the overall health of the country, as well as sovereign spreads. And then we'll also have a local analyst. My role is within Latin America as well, to focus on local markets and currency. And we'll really work together on a regular basis to assess our view, not only for the country, but also for the various assets within that country, whether it be the dollar pay paper, the local, or the corporate. As you head down toward the bottom of the page, you see that we have many firm-wide resources that we use. Supporting the EM team is our entire credit analyst team. So we won't invest in a corporate if it's not a country where we're very positive on from the macro perspective. So there's regular and frequent communication between our country analyst and the credit analyst that is evaluating a particular corporate issue within that given country. This holds true both for our currency team as well. We have an office in London where we coordinate our currency views with Payden members housed both in Los Angeles and London. As I delve into the specifics of our strategy, the real important aspect that I want to underline is our process from beginning to end. So in terms of our view for country allocations, the first step is really understanding country by country what some of the risks are, what some of the opportunities are, and how transparent the economic structures are. Political risk, as an example, is something that we've highlighted recently internally with an observation that calendar year 2014 will usher in elections across a very broad number of countries. So that's something that we're already looking out for. Once we've done our fundamental country research, the next step is to look at asset allocation perspective. I'll be getting to Colombia as an example on the next slide, but within Colombia, if our step one fundamental research shows a conviction level on the country as a whole, the next question for us is, where do we see the opportunity within Colombia? Is it in the dollar-based sovereign debt, the local debt with currency exposure, or the corporate debt? And really that is a country-first decision and then an asset allocation second step. Finally, once we decide on the particular asset within, say, Colombia, the real question we have to ask prior to investing is, from a relative value perspective, where do we find the cheapest bonds on the yield curve? Where do we think that the monetary policy is headed relative to inflation and growth trends so that we can position on the curves to best optimize our view on a particular country? To be even more specific, here's an example of a scorecard in which every 3 months we have a regular scoring meeting. Each analyst has countries assigned to them, and their responsibility is to come up with a health scorecard of a particular country. While we do this quarterly, we also have regular meetings across the various asset classes within EM that we invest in, and then we have daily conversation about price action, news events, and important points of discussion. I'm going to speak specifically on Colombia and looking at this scorecard approach to give you a real sense of how we do our work here on a daily basis. Specifically, we feel that there are a number of factors that will drive the health of Colombia, and when you look at the weight column, we've assigned various weights to the different factors depending on our belief on how much that particular factor is going to affect the trajectory of the country fundamentals over the next 6-month time horizon. As you can see in this example, politics has a very high weight at 25%, as there's a change undergoing in Colombia, and we're very optimistic as it relates to the potential for politics in Colombia, specifically talking about a potential end to the FARC insurgency. And so when we score that politics a 4, our choice is to choose anywhere from a 1 to a 5. And in this particular example, and across all of them, 5 is our highest conviction or for a strong improvement, and 1 would be for a strong deterioration. While we have a weighted average score listed at the top at 4.05, there is no score within each sub-factor of Colombia that's below a 3. So the bottom line is that Colombia comes out from a fundamental perspective as a positive opportunity to invest in. The question that we'll get into is then how do we move on to step 2 in terms of assessing both dollar pay, local, and corporate opportunities. In terms of dollar pay being the first opportunity set, we actually then, once we have our score for a particular country, we actually then forecast the movement and the spread of that particular country, as well as calculate a percent total expected return. Again, the percent total expected return is our 6-month forecast of total return in that country. You can look at a various list of countries that we've included in this analysis. We do this for all 55 countries in the index, and we come up with a total expected return per country based on our economic scenarios that are set at the firm-wide level from a best case to a base case to a worst case. We're trying to ascertain over the next 6 months, how do we view the global outlook? Because if you have a most optimal scenario in terms of spread compression relative to a worst case of spread widening, we're trying to assess what is the probability of each scenario playing out over the next 6 months. And that helps drive, in the shaded orange box, our weighted 6-month spread forecast. Switching on then to the next page, when we have our dollar pay spread forecast and total return forecast, if we have a strong view on a country like Colombia, the question is, what is the local market opportunity? And then secondarily, how does the forecast for local returns look? So on page 18, we're talking about we're trying to outline for you the view on local markets and what factors matter most to us in terms of assessing the potential opportunity in local markets, both from a rates and a currency perspective. And so we start with looking at the central bank. Transparency in emerging market central banks has grown through the years. These banks still have monetary policy tools available to them that many of the developed markets don't. And so really an understanding of central bank transparency, the direction that the central bank is looking to go in, drives a lot of our investment decision. We also want to make sure that we have a view on the interest rate outlook, whether we're talking about deposit rates or out the term structure, to see where the opportunities are and where the risks are. Once we have a view on the interest rate outlook, we also want to understand currency directionality. Which central banks are more tolerant of a FX appreciation? Which central banks are intervening in the markets? And then secondarily, what are the technical factors that will drive currencies and rates? And what is the investment in that market? How much foreign ownership is there in a particular market? And then lastly, liquidity. Liquidity matters quite a bit in emerging markets. The different asset classes, corporates, dollar pay, and local, have their own liquidity considerations. And prior to investing, that's clearly one of the major factors that we consider. When speaking about our views for local rates directionality juxtaposed to our view for the currency, we really believe that in the local rate space, it provides an opportunity to decide, do we want to only capture the local rates move? Do we think that we have a particular view on the currency and the local rates move? Or do we want to only capture the currency move? And so given the opportunity for the liquidity that exists, we can quickly ascertain whether we want to, for an example, in Colombia, get access to the local rates move and the currency, or just the rates move. And in that particular example, recently as a strategy decision, we focused on an opportunity to capture the rates market exclusively. And so that's an important distinction in the local markets, is that you can really go amongst this quadrant in either direction depending on your macro view. That really speaks then, the next step is the currency scorecard. So we really take a lot of time to figure out much, and this is very similar to the dollar pay spread forecasting that we do. There's a consistency to approach in that we're looking at the various factors on the left that may impact each of the various currency markets. And then on the bottom half of the page, we use the same 1 to 5 scale to indicate direction and conviction level on the opportunity set. Ultimately, we come to a weighted score at the bottom that indicates 3 and above, most positive outlook for a currency, and below 3, not quite as positive outlook in terms of the near-term trajectory of the currency. This is all weighed against our understanding of valuation and purchasing power parity, but this at least gives us a very quantitative approach. In Brazil, as an example, that's the country that I'll detail this scorecard through. I was actually just there about 6 weeks ago. And so while we do this quantitative analysis to figure out our true view for the currency, some of the nuances of the currency market, especially one like Brazil, where the central bank has been rather active, are best picked up by research trips. So as a group, we're constantly visiting various countries to get our on-the-ground research view and use that to augment our view on the quantitative approach. So just kind of thumbing through Brazil here, you can see that rates, I've detailed 20% of the 100% allocation in terms of its impact on directionality. Brazil central bank has been quite active, and to the extent that they hike more than the market expects, that's supportive of the currency. That shows an indication for a view for anchoring inflation expectations. And to the extent that the central bank is dovish and cuts more than the market expected, which is what you saw last year, when the central bank was extremely aggressive in lowering deposit rates, that's going to have a negative score on the currency. And as we sit here today, the central bank is just recently hiked, but is trying to stay relatively inactive, only being forced into action due to inflation trends. Another example in looking at the variables that impact the currency view is our view for growth. So growth is at 10% in Brazil in terms of its weighting, and with growth being at a new lower level, it's not ideal for the forecast for the currency. And so ultimately, when you combine all the factors, in Brazil as an example, you get a neutral outlook for the currency. That is this one window of our view and what we use in terms of stacking up these scores against each other. But again, other factors such as the carry, the valuation, and the nuances of the technicals of that market play a role in our decision making. Once we have our currency view, again, looking at particular local markets, we want to understand what now is the expected total return of a particular local market when you factor in the currency view and the rates view, and then ultimately, in terms of the opportunity set, comparing it to the dollar pay view. So sticking with Brazil as an example, the percent total expected return in local Brazil, both rates and currency, over the next 6 months is 6.4%. This was just done on March 31st, and so we'll use this as our most recent assessment of all the local markets. When you contrast that to the percent expected return of the dollar pay market, which is done by our aforementioned sovereign analysts, they're forecasting a 3.6% for the dollar pay market in Brazil. So in this particular example, it would be compelling to have an overweight to local Brazil. And if you can see in the far right column, Brazil is one of the green highlighted countries in which we have an overweight to the local markets. The local markets, I would just underscore, I think, a very important point in that when you look at the coupon income of the local markets, coupled with the potential for FX appreciation and the potential for price return on the local bonds, while that cuts both ways, you can get to some rather compelling total return forecasts over a 6-month period, and that's reflected in our quantitative analysis approach. I want to highlight a couple specific local trades because I think that when you look at this Peru example, it really underscores the question. A lot of investors have done rather well in emerging markets, not only in the past year, but over the past 10 years. And the question we get asked sometimes is to look at relative valuation and how do you rotate amongst dollar pay, local, and corporates, which I'll get to next. The graph on the left I thought is an important highlight of dollar pay versus local, with the top white line being the yield to maturity of the Peru 2037 local markets. And the bottom line is the Peru 2037 dollar pay markets. And this was an opportunity where we were in the dollar pay markets earlier last year at a spread of over 175 basis points to treasuries, and that spread came all the way down to 75 in October. So when we're looking at a spread in Peru dollar pay of a 2037 maturity bond at 70 basis points over treasuries, the next logical question is, what is the local market yielding? And in this case, it was a compelling switch to move into the local markets, which we did across our strategies in October. The local pay has done rather well, while the dollar pay, as Kristen mentioned, had suffered some spread widening in the first quarter of the year. And so this becomes an example of, well, now is there an opportunity to rotate back into the dollar pay? So it's the constant rotation between local, dollar pay, and corporate in terms of relative value analysis that drives our decision. Interestingly, on the far right of this chart details the Peru currency directionality, and this is actually an overlay of two particular items. One is the spot rate of the Peru currency, and one is the 3-month forward points. So as we mentioned before, we can carve out only the local rates exposure, or we can also augment that with the FX exposure, or alternatively hedge the FX exposure. There's typically a cost of hedging the FX exposure given the interest rate differentials. And what this chart highlights is that while at the beginning of the trade, we had an open currency position when we rotated into the local bond, the lower sub-zero red data points show you that with Peru deposit rates at 4.25% and U.S. deposit rates floored, there should be negative carry to hedge Peru as detailed by all the green periods. But in the first part of the year, you actually got paid or compensated to hedge Peru currency exposure. So when we looked at the portfolio as a whole, considering our LATAM exposure, we chose to hedge out the Peru FX risk as a tactical decision and actually got paid to do so. So another example of how we're looking at the various opportunities and how that changes over time. Sri Lanka is the other local market I wanted to illustrate. There's a lot of commentary in the marketplace about Mexico and how well Mexico local rates have done. Many of the IG country local markets have done rather well. But there's a lot of other markets that don't get quite as much focus but offer compelling yields. And so Sri Lanka is a market as a strategy view that we've participated in that is double-digit yield to maturity. And after the currency had depreciated, we saw an opportunity with the current account deficit improving to add to local Sri Lanka. So we view this as a diversifier and an opportunity to gain some nice healthy yield. And again, if you get the yield compression and the price appreciation from the bond, the forecast for total returns is rather compelling. And on the previous slides, when you looked at all the local return forecasts, Sri Lanka came up as a compelling opportunity. I've talked quite a bit about the local and dollar pay markets. The third element is the decision to own corporates. As Kristen mentioned, the amount of volume in corporate issuance is rather large and is growing at a historic rate to the point that the cash market is as big as the high yield cash market within corporates. I want to highlight in terms of this page that the criteria for investing in a corporate really also starts from about 5 subcategories in terms of business environment, free cash flow considerations, the management team, liquidity considerations, and protective covenants. And so what we will have is our credit analysts will communicate consistently with our country analysts to make sure that the credit that we're looking at, we have a positive view on the country. And we will never invest in a corporate issued by a country where we first don't have a strong view on the country. I wanted to highlight that the selection process and the evaluation is again consistent with both our dollar pay and local scoring approaches. And within corporates, we use a 6-factor evaluation model, looking at the various components that will drive corporate outperformance and illustrate the health of a particular corporate market or credit issue. I'm actually going to turn it back now over to Kristen, who's going to talk about some of the specifics within our strategy themes, our portfolio characteristics.
So in terms of strategy themes that we are implementing across all of our portfolios, this gives you an indication by region of how we're positioned. So within Latin America, I mentioned that in some of the IG countries, investment-grade countries such as Brazil, Colombia, Mexico, and Peru, those are markets in the dollar pay space where we've rotated out of some of the dollar pay sovereign into corporate markets there. And right now we have our consumer analyst is in Peru on a research trip looking at some of the consumer corporates that were invested in really as a play on some of the growing middle class in a very fast-growing country like Peru. Our financials analyst will be going to Colombia and Chile next week, and one of the best regions that we think in terms of looking at emerging market banks is in Latin America in terms of stronger regulatory regimes and where we find value. In terms of local rates, as Darren mentioned, we've had the Brazil trade on for quite some time. We also like Mexico quite a lot. Alex King, one of our sovereign analysts, was recently in Mexico, and there's a lot of talk now in the press about Mexico's moment, meaning with President Peña Nieto having come into office and really starting a number of different structural reforms, including energy and fiscal reform, we see the potential there for upgrades and for positive impact on asset classes. And so Mexico is also our favorite currency in the region. Within emerging markets, in terms of emerging Europe, Africa, and the Middle East, we've avoided the Middle East for the most part, with the exception of United Arab Emirates and Qatar. And in those countries, most of our investments are going to be in corporates and quasi-sovereigns or government-owned corporates. Our energy analyst was recently in these countries, actually last week, and visiting a number of different corporates that we own there, and are positive in a number of energy companies in this region. We've been underweight South Africa for some time, but we do like a number of the new African countries that have issued, as well as Nigeria local markets. That's one of our largest overweights in the African space, and an area in Africa that does have more liquidity in that market. In terms of currency in the region, our exposure there has been concentrated in the Russian ruble and also in Romania, which is a recent addition to the local index. Within Asia, in the dollar pay space, we don't have a whole lot of sovereign exposure because dollar pay spreads in the sovereign space are fairly tight. We do like some quasi-sovereigns, though, in Indonesia in particular. On the local space, we have exposure both in India, which has opened up quota more recently to foreign investment, and as Darren mentioned, to Sri Lanka. Arthur Hovsepian, who heads up our Asia Sovereign Research Group, will be going next week to India and Sri Lanka, and I think that should be a very interesting trip. And then in terms of currency, our favorite currency really is the Philippine peso. And I think that's one of the best ways to gain exposure to a very strongly improving credit story. To give you a sense on page 28 and 29 of how we're positioned in our dollar benchmarked strategies, you can see some of the themes that I just mentioned sort of played out here on page 28, where we give you a sense of all of the different countries on the index. As I mentioned, there's quite a few, and then how we are positioned versus the index. And then on page 29, in terms of the overall portfolio characteristics, the yield on this portfolio is 6.5%, quite a bit higher than the index yield of 4.8%. And that is really coming, again, from getting into a number of off-index types of opportunities, whether it be in the local or the corporate market. And we're still a high-quality, high BB type of rating, and I think that's a very attractive yield to earn on a higher quality portfolio. Our quasi-sovereign, which is 100% government-owned, is about 20%, and then we have, in addition to that, about 28% in private sector corporates. And then on the right-hand side, you can see a number of different local markets that we are involved with. So again, this is going to be off-indexed, going into the local markets on this dollar pay benchmark. Darren, do you want to talk about some of the, we have performance attribution in here actually also on page 30. And as you can see, I think we've done a very good job over the past 5 years in outperforming both in up markets and down markets. So outperforming in 2008, which was a very difficult year, but also in 2012, which was actually a very strong year.
I'm going to highlight our local currency strategy. So while Kristen detailed that many of the local currency high conviction views are able to be in the dollar pay strategy as well, what I'm specifically talking about is our local currency strategy. And so when you see that there's a couple overweights regionally coupled with a couple neutrals, it implies that we generally have a positive view on local rates, and there's many countries within there that we have specific positive views on. Mexico, as an example, has been a medium-term overweight for us. It's been probably the best performer within the local space year to date. But as you can see, in many other countries, specifically within Europe, looking at Russia and Turkey, there is opportunity for us to capture specific country nuances in terms of the central bank's dovishness or disinflationary trends coupled with generally global slower growth. So while we detailed earlier that EM has a higher growth outlook than some of the DM markets, inflation trends are rather favorable for the moment in many of these countries, And in countries where they're not quite as favorable, real yields have often been higher. So the idea to own inflation-linked bonds, which we do in Brazil and Uruguay, as two examples, and as Kristen previously mentioned, serve a role in a portfolio like this. Ultimately, it gets you down to some of the big picture characteristics. So you can see in terms of our interest rate duration that we're running a longer duration profile than the benchmark. This is specifically based on our positive view on local rates markets, but it's very different than, say, looking at some of the other strategies in that there's a wide variety and diversification of the overweight to duration. So, you know, as I think about it now, no particular country at the moment is over 0.3 of a year long relative to its benchmark. And so there's really just a number of countries that we're optimistic on in terms of the local rates outlook. What this also gets you to is a nice healthy yield to maturity of 6.9%. And as you look specifically in the top right box, I really want to underscore that the credit quality here is BBB+. BBB+ with 6.9% yield to maturity and 6.5 years of duration is a very compelling combination of variables. And when you look in terms of how performance has been, we started this fund in 2011. 2012 was a very strong year, both for the index and for our fund. And while performance is relatively flat here through March, we've had a nice pickup in April as investors, whether responding to the BOJ or the general lack of geopolitical headlines, have been continuously moving assets into local markets. At this point, I'm going to wrap up the presentation part and move into the question and answer session.
Great. Thank you very much, Darren and Kristen. We have a handful of questions to get started, but I just wanted to remind everyone to please utilize the Q&A feature on screen. We'd like to take as many questions as we can in the next few minutes. So I'll get started with our first question. What is your response to the talk about, or the question of, is now the right time to invest in emerging markets? If you can shed a little light on that.
Yeah, I think that when people look at the positive returns that we've seen, they tend to question whether now there's still opportunity in the asset class. And I think that the big picture message of our presentation is the asset class has evolved and the selection has evolved such that there's a dramatically larger number of dollar pay countries, sometimes first-time issuers. There's corporate dollar pay first-time issuers, corporate local issuers. There's close to 20 local markets that we consider investing in. So the menu of opportunities at EM has expanded such that looking to rotate amongst the different asset classes and seeking value in each of them is the way to carve out a fair amount of healthy returns on top of a compelling yield to maturity relative to the credit quality.
And I think the yields are still very attractive. I mean, we've been talking about these strategies that are yielding, between 6.5% and 7%. So I think that as compared to other fixed income alternatives, just given the improving fundamentals of this asset class and the higher credit quality nature of this asset class, I think that's a very attractive yield.
Thank you. This is a compare and contrast question between two of our products, the EM Debt Fund and the local currency version. In addition to that, what dynamics do you see that would favor one version over the other?
Well, I think with the dollar benchmarked fund, although we are using local opportunistically and corporates opportunistically, which makes this fund less interest rate sensitive in terms of sensitivity to U.S. Treasuries than perhaps other pure dollar pay funds. Your view on U.S. Treasuries will have an impact on the portfolio in this fund, more so perhaps than it will on the local pay fund, because the local pay fund isn't a spread to Treasury type of an asset class. The local pay fund will, of course, there will be an impact if U.S. Treasury yields were to rise dramatically. Of course, that's going to affect other global bond curves as well. But you do also have a currency component there that would offset that if it's in a positive type of market environment. To
piggyback on that, there's a for example question here. if one was bearish on the U.S. dollar, should they prefer the local fund?
Yeah, I mean, if you're bearish the U.S. dollar, the local fund has the highest sort of underweight to U.S. dollar, and then the fund is 100% local currency. At the same time, the question is, our highest conviction local views on currencies also go into the dollar pay fund, so you're able to carve out selective currency outperformance should the dollar weaken. But as the dollar pay fund is largely dollar focused, so it really ultimately comes down to the allocation decision and why are you owning EM. In terms of relative value, both have compelling stories. We've seen clients use EM dollar pay or even local as alternatives to some of the long-standing investments they've had. We've also seen more recently certain investors that have an EM equity allocation choose to use the EM local strategy as an alternative to the equities, given the really compelling coupon income, still having the FX exposure, and also the potential for these rates markets to add price return.
And just to, so that you have a feel for how we use local currency in the dollar benchmarked fund, typically we're going to be going from 0 to 30%. Right now we're close to 20% in local. So that gives you a sense of the range that you'd be in terms of local currency in the dollar pay benchmarked fund.
Okay, to piggyback on that, how would your funds respond if we saw a rise in rates, for example, if rates rose 100 basis points?
Well, I think that, again, in the dollar pay fund, while it is a long duration, because many of these countries are able to issue 20 and 30-year paper, one of the things that we've been doing is that we're heavily underweight that 30-year sector, and we've moved out of some of that interest rate sensitive paper into more spread sensitive paper that's going to be shorter duration, so into shorter duration corporates or into shorter duration local. So we've taken measures within the dollar pay fund, which is most susceptible to that backup in treasuries, to reduce some of that interest rate sensitivity. And I think that you have to keep in mind also that you've got a spread cushion. So if treasuries do back up, there is room for spreads to tighten and to offset some of that negative price impact.
Okay, thank you. That is our last question. I just want to turn it over to you both for final comments before we conclude today.
Well, I just want to thank you all again for joining us, and I think the message here is that there is still opportunity, and we're still positive from both a fundamental and technical perspective, and we think that alpha is really going to be attained by having the flexibility, which we do in our fund products, to move in and out of asset classes and to look for new opportunities with newly issuing countries and new issuance within the corporate market.
I would just add to that the emerging markets potential for performance is not just merely a reflection of global assets looking for homes. There's specific evolution in terms of the growing depth of the asset class, the opportunities, the improving credit quality, and the compelling yield relative to alternatives. And I thank you for your time.
Thank you both, Kristen and Darren, and thank you everyone for your attendance today. We will be following up with a PDF of the presentation today, so watch your inbox for that, and a recording will be available as well.